So, SoFi has just been falling and falling for seemingly no good reason. I mean, like the rocket ship was taking off when it was at $18, and many bought the stock then, but are now down significantly as SoFi continues to crater instead of rocketing up. But many of us bought in the $4 to $5 range, even up in the $6, $7, $8, $9, $10 range, and are still up massively and not worried at all. So how did I know to buy SoFi stock back then? And when is the best time to buy SoFi stock now, since you can't go back and retroactively buy, obviously? So when is the best time to buy it now? Well, we will discuss exactly how I knew to confidently buy SoFi despite everybody saying run way back then. And even last year, many were saying it was a dead stock, but I knew to buy that stock before the run happened. So let's take all that, put it all together, and discuss how to know when to buy SoFi stock today. Just make sure you like the video if you like getting the truth without the hype, because that's exactly what you're going to get today. So how do you know exactly when to buy SoFi stock? I mean, that's the question on everybody's mind. And the last point that I'm going to make, there's 5. The last point that I'm going to make is the biggest one. And honestly, guys, it doesn't get talked about enough, but we're going to talk about it today. And remember, if you're serious about making money in the current chaos that's going on, and yes, guys, there's going to be big money made during this time, and you are ready to take advantage of it, make sure you take advantage of the March Madness sale going on right now, where we show you exactly how to do that. It's the pinned comment down there, but we'll talk about that more at the end. We got a lot to get into here today. So let's get into the steps, and let's start with the first one. So number 1, ignore the noise. This applies to both the bulls and the bears, guys. You have to ignore all the noise around this stock all the way around. I mean, back in the day, it's just a student loan company, which I still hear that sometimes today. I still hear folks saying that it's just a student loan company. So they clearly haven't been paying attention to the stock or what's gone on with the company in the past 3 years. But that's a narrative that is out there and that persists. Or I hear about share dilution from time to time, which again seems to be a YouTube thing, not in any other place thing. But hey, here we are. I hear that one again. And even last year, I heard repeatedly, it's a dead stock. It's not worth anything. It's going down. It's just a bank. All this other stuff was all negative sentiment, all negative noise towards the stock whenever the stock was low. And then guess what happened, guys? The noise flipped. And once it started running up, that's really when the noise flipped to the opposite end of the spectrum. Then it was a super short mega gamma, sigma risla squeeze up to 45, and then it's going to squeeze up to 75. And then, I mean, there were folks out there actually saying and thinking, hey, is 100 possible? And then I started reading my comment section on any SoFi video I put out there, and people were making crazy price projections. And of course, or they would just flat out tell me, hey, Luke, you're wrong. You have no idea what you're talking about. It's going to be at this crazy price by the end of 2025, $75 at the end of 2025, or whatever the case was. The point being, it was all noise in the end. And there's no way those folks were basing that on anything tangible outside of hype or noise. Same exact thing with the bears. All that stuff in the end, both bull and bear, especially when you get extreme, is typically trash. And I'm just trying to be as straight up and as honest as possible. That's what it is. And that's what you have to avoid as an investor, or else you're going to lose a lot of money. And more importantly, you're never going to buy at the right price. You're always going to miss it up and down. So number 2, the management team. Now, I agree with all you guys that want to talk about, hey, Luke, that's really, really hard to know up front. It was really, really hard to know, 3 years ago that Noto was as good as he was, and that a lot of the members on his team are as good as they are. And I agree with that completely. Obviously, there's sometimes you get a CEO that's, is kind of well known, been around for a while. You can go back and look at the track record. But management team may be one of the harder things to do in regards to, you can learn valuation. You can learn a lot of different things in regards to the stock market. But I mean, I don't know, there's, thousands of executives out there. You can't possibly know them all. This isn't sports, We can't go out there and figure that sort of stuff out. So it's really hard to know up front. However, you got 3 years or 4 really to basically know this management team before it ran up big time, right? So you got a long time to sit around and assess the management team. Now, the first time the stock ran up, it was just pure hype. It was nothing there. There was nothing to go off of there. So you really couldn't judge the management team back then. But when you do go to look at a management team over the time, right? Over the course of this past 3 years, especially in regards to SoFi, you've got to look at, are they hitting their marks or not? Are they executing to their vision? Not Wall Street's vision. Are they executing to their vision? And I can say a resounding yes to all that sort of stuff. Not only have they hit their guidance, they beat and raise and beat and raise and beat and raise. I don't know, like 15 different earnings calls in a row. This happened. I mean, it was an incredible run of beat and raise, rinse and repeat for years. That is called execution of a management team. And that is how you know you have a great management team there. Now, the other piece of that, and it's another thing that, okay, let's just say you happen to miss that for whatever reason. Okay, fine. You also got to look at another key component with SoFi. It is incredibly hard to turn around a company's entire business. And that's exactly what happened. They went basically that student loan narrative that we talked about in the first point there. That was true. However, they had made the decision to change once all the student loan mess happened and everything else into what it is today currently, which has really nothing to do with student loans. They still do them, of course. There's a lot of things there, but that's not their focus. That's not their future. That's not anything there. And the turnaround is incredibly hard, but they pulled it off. That is execution on a high level. That is a management team operating on a really high level. And that right there is another key to let you know, hey, I've got a great stock here, but it doesn't give me everything that I need in regards to knowing when to buy. So we got to go on to the next step. So number 3 is due diligence told me it was great. This is why I preach it so much, because I knew what I owned. Even way back in 2022, I knew that I had something special there. I didn't base that on a YouTuber's opinion or a newsletter or the news or CNBC or Kramer or anything, any sort of, followers on, X or anything else like that. I ignored all of them and instead did the work on actually deep diving the company, getting into it, doing actual due diligence on a company, which does not happen over the course of a few YouTube videos. It does not happen over the course of an hour. It takes days, sometimes weeks, sometimes months for me to complete due diligence on a single company that I may or may not end up buying. I may do all that work and then decide I'm not going to buy it. Is that a waste of time? No, not if you understand investing and you understand business and you understand how successful people do that. It means I'm avoiding a bad asset. That's the first giant positive. The second is I got to exercise a skill. That's like going to the gym, a basketball player, and I don't know, they put up 1,000 shots, we'll say, and they only make 600 of them that day, whereas supposed to the prior day they made 800 of them. Is that a failure? No, they put in the reps, they put in the time, they have some things to correct, they have some times to get better. You're not going to get better by simply sitting back and only shooting when you know you can make it, and only doing 2 shots because, hey, I made my first 2. Let me just stop right now, so that way I don't pick any and I don't shoot any shots that I miss. That's not how that works. When you deep dive a company as deeply as you should when you're doing your due diligence, you know exactly what their strengths and weaknesses are. You know what they do good, what they do bad, what the financials are, what the projections are, what the future is of the company, not speculative future, the real future of the company. And more importantly, it becomes much easier when, the crap hits the fan per se, even on an earnings call. When an earnings call is bad, you can tell the difference between a temporary problem and a fundamental problem, which is massive in being able to spot opportunity from a disaster. The more due diligence you do, the more work you put in yourself, the easier it becomes and the less likely you are to get scared to buy when it's cheap because you know exactly what you own, and vice versa. You also don't FOMO in because hey, they may get to that price one day, but it's not today. And to lay off that stage. But it's especially helpful when the fear is high, when the noise is high, when the stock is falling, all those other things are happening. Maybe they have a rough earnings call. The point being, you know what you own, and it is so easy to spot opportunity from disaster. Number 4, earnings performance. Now, we just talked about earnings a little bit here, but I'm talking about the performance on the earnings call itself. And you have to go deeper than the headline hit or miss. I don't care about any of that sort of stuff. Remember, a lot of those things are Wall Street's expectations, not my expectations, and sometimes not even what the guidance is that management put out there. So, sometimes you're kind of like, well, management hit their guidance. They just didn't hit Wall Street's, but yet it's a quote unquote miss. Whatever. Let Wall Street be dumb. That's traders playing trading games. I don't have any interest in that. What I can tell you is with SoFi, each quarter, the numbers and the earnings performance get better every single time. But that doesn't mean because earnings are getting better, stock price is going to follow, right? Especially when we're looking to buy, this is where understanding those different nuances really, really helps you spot that opportunity from a disaster. Basically, hey, back in the day, they turned a profit, right? And then it seemed like it fell right back down after an initial run up after turning a profit. I mean, sometimes they give better guidance and it's like it falls right back down to a low again. I mean, that is what happens, and that's what happens with stock price movements. But the earnings are what matter, not the stock price movement. And when you understand that, that is how you make a lot of money in the stock market. But most people unfortunately judge a stock based on the stock price and not the actual earnings, which is why a lot of us as retail investors routinely buy high and sell low. We just think for whatever reason, stock must be great at all-time highs, and that same stock must suck whenever it's at a lows. Now, to be fair, that could be true, but you're using the wrong metric to find the real answer to that question. The earnings is going to tell me if the price action is giving me the opportunity for a steal deal or if it's a complete ripoff. And yes, even great companies can be ripoffs at times. I mean, see SoFi in 2021, for example, at over $20 at the time. Total ripoff. Same with Palantir at 40 in 2021 and Tesla at 400 in 2021 and so on. Those were all absolute ripoffs in regards to the stock market. However, the earnings told me that there were some great things happening underneath the surface with that, and I needed to actually dig in there a little bit deeper and not be scared away from the stock. But I'm not necessarily going to buy that stock either because of step number 5, and that is valuation guided my buys. And don't worry, guys, we'll discuss exactly how this all applies to SoFi today. Don't worry. But I know this is the other thing I talk about all the time on this channel. I know a lot of you guys get, a little bit upset, but I'm sorry, it's that important. When you do a real valuation based upon management's guidance, you have a real and reasonable way to calculate fair value. And when you use formulas or calculators and input stuff 10 years into the future, or you use made up projections to 2030 that somebody made up or whatever the case is, I'm sorry, you're simply fooling yourself with those numbers. You're basically speculating using a formula, which gives you kind of a false sense that you are prudently seeing the future value, when in fact you are simply speculating in the first place and just throwing out a random guess that is basically just as accurate as a random guess. You can't know. It is impossible to know if buying SoFi was a great deal in the first place if you didn't do a valuation today based upon the numbers that we currently have, and maybe a year or two out into the future. That's about as far as you can go. And if the management doesn't guide out there that far, you only got 1 year, well, there you go. That right there is the most accurate information you have. If you'd done a valuation on SoFi, you would not have bought at $18 earlier this year. You would have known it was overvalued. It was very easy to not buy because I understood valuation. And the same exact thing when it was down at $7, for example, not that long ago. It was easy to buy the stock, rinse and repeat over and over and over again while it stayed down at those levels. Now, I can also look forward 2 years because management guided towards the next 2 years, and I can use a reasonable multiple and get a fair value in a 2-year time frame. And guess what? When I did that, and I have done that for my group specifically, it's not $45, much less $75, much less $150, like I've seen out there for what it's going to be at the end of 2026. Now, of course, I think management is sandbagging those numbers. And of course, I think they beat those numbers because I have no reason not to believe that, given the prior track record of the previous 4 years. But do they beat them by triple, by 5x, by a 10x? I mean, that is what you have to do to meet some of these projections that are out there. That's why I call those speculating, because speculating is how you end up making the devastating mistake of buying a great stock at the wrong price. And it's one of the few ways you can actually screw up buying a great company. And don't believe me? Well, just ask those Tesla 2021 shareholders that bought the hype and crazy speculative projections instead of just simply using simple valuation. Ask them how they feel with it being 4 years later and they're still down, 40, 50% or so from those highs back in 2021. My guess is you're not feeling so hot with all that. Heck, even take the folks that were all over SoFi back in that time, but they bought at $20, how they feel today. So how do you know when to buy today? All right, so let's answer the question right there. And the reason why I gave you everything is because that's the first part right there. That is how you know when to buy today, is when you do everything we just discussed. That's why I had to discuss it. Otherwise, you wouldn't really know. So that right there is the first thing you have to do. If you skip those, you cannot do anything else I'm about to say, because doing all those things allows me to do number 2, which is to get a valuation. And then I set my price target to buy from there based on my plan, my situation, everything else, my goals, everything else that's going on, my risk tolerance, everything else, how many shares I want to own or how much money I want to own in regards to dollar amount into the stock itself. And because you've done all that, you can also just simply set your price target to what you calculated fair value to be, and then start your DCA whenever it gets to that price or close to that price, for example. Or you can just do a straight DCA from the start and set it and forget it, and maybe use that fair value calculation as just some time to maybe go a little bit heavier on that DCA whenever it gets below it, and then maybe go a little bit lighter whenever it gets up above it, so that way you can kind of stack back that money back here to buy those cheaper shares later on. Doesn't matter in the end, but if you don't do the 5 things we just listed, you will fall for the hype or the fear and either buy too high or not buy when it's at a steal deal. Unfortunately, that's the bottom line for most folks who don't get these concepts down and use them. And if you want to learn and you want to work directly with me and you're serious about learning this, you want to work with me and the rest of our 6, 7, and 8-figure investors and our team in there in my group, we do have a March Madness sale going on right now where you learn all that. You get 5 free courses, you get your free coaching. I put out 2, 3 videos a week in there just simply for in there. Obviously, we do live Q&As. There's so much going on in there. You get my complete watch list with price targets, all my buy and sell alerts. Guys, there's so much in there. Just check out the pinned comment, see if a membership's right for you. And click this video here if you want to see exactly what I'm buying in this market. And click here to see my exact plan for this market. So thanks for watching, and we'll see you in the next one.